The real reason: China walked away from $688 billion in U.S. debt. What if I told you that China just walked away from hundreds of billions of dollars on purpose, not because it had to, not because markets collapsed, but because holding on was more dangerous than letting go? Quietly, over the past few years, China has been selling U.S. government debt, the safest asset in the world, and in the process, locking in massive losses. No emergency press conferences, no flashing red alerts, no dramatic warnings on financial news, just a slow, deliberate exit from a system it no longer fully trusts. And that should make you stop and ask a question most people aren't on it asking yet. Why would the world's second largest economy willingly lose money on assets designed not to fail? For decades, U.S. Treasury bonds have been treated like the foundation of the global financial system. They fund American spending, anchor global interest rates, stabilize currencies, and sit at the center of pension funds, banks, and central banks across the world. China understood this better than anyone. After its export boom in the early 2000s, China accumulated more U.S. dollars than it knew what to do with. So it recycled those dollars back into U.S. debt, becoming America's largest foreign lender and, in effect, one of the biggest pillars holding the system together. It was a quiet arrangement built on mutual dependence. The U.S. consumed, China produced, and U.S. debt kept the machine running smoothly. But something has changed. China is no longer just trimming its holdings. It's reducing its exposure at a scale that would have been unthinkable a decade ago. Selling bonds, even as rising interest rates guarantee losses. That's not normal portfolio management. That's a signal. Because when a country like China accepts losses on purpose, it tells you the risk it fears is no longer financial. It's structural. It's political. It's about control. This story is not about a sudden dollar collapse or an imminent market crash. It's about a slow shift in trust. A realization that money held inside another country's system is not truly neutral. That what was once considered risk-free now carries conditions. As global tensions rise, sanctions become weapons, and financial systems double as tools of foreign policy, China is making a calculated move. Reducing dependence before dependence becomes a liability. And while this sell-off is happening quietly, without panic or drama, its consequences will shape the future of U.S. borrowing, global markets, and the balance of financial power for years to come. If you want to understand the world before headlines, do subscribe. The Silver Collapse Report. At the start of the 21st century, China didn't set out to become the world's largest creditor. It happened almost by accident. As factories across China expanded at historic speed, cheap goods flooded into Western economies. The United States consumed more than it produced, while China produced far more than it consumed. The result was a massive and persistent trade surplus, paid for in U.S. dollars. And soon, China found itself sitting on mountains of American currency. Holding that much cash was dangerous. It could push up the value of the yuan, hurt exports, and destabilize China's growth model. So Beijing made a logical choice. Recycle those dollars back into U.S. Treasury bonds. U.S. debt offered liquidity, safety, and scale. No other market on earth could absorb such enormous sums so reliably. By buying treasuries, China stabilized its own currency, kept exports competitive, and helped finance American government spending at the same time. This arrangement quietly tied the two largest economies together. The U.S. got cheap financing and affordable goods. China got growth, jobs, and access to global markets. It wasn't an alliance built on trust or shared values. It was built on incentives. Each side depended on the other, and for years the system worked. At its peak, China held over $1 trillion in U.S. government debt, earning it the title of America's largest foreign lender. Markets viewed this as proof of stability. If China trusted U.S. debt, then everyone else could too. Treasury bonds became the backbone of global finance, the asset that anchored interest rates, stabilized banks, and supported pension funds worldwide. But this dependence came with an unspoken risk. By parking so much of its wealth inside another country's financial system, China was trading sovereignty for stability. And as long as the global order remained calm, that trade seemed worth it. The problem is that global orders don't stay calm forever. As geopolitical tensions rose, trade wars emerged, and financial systems became tools of state power, China began to reassess a question it had ignored for decades. What happens when your savings are held inside a system you don't control? That question would eventually change everything. To understand why China's decision is so unusual, you need to understand how bonds actually work. When interest rates are low, bond prices are high. When interest rates rise, bond prices fall. For years after the 2008 financial crisis, the Federal Reserve kept rates near zero. During that period, U.S. Treasury bonds were expensive but stable. China accumulated large amounts of these low-yield bonds, expecting long-term safety rather than high returns. But inflation changed the equation. As prices surged, the Fed responded aggressively, raising interest rates at the fastest pace in decades. Those rate hikes crushed the value of older bonds. Suddenly, treasuries issued years earlier were paying far less than new ones coming onto the market. Selling those older bonds now meant locking in losses. Any rational investor would prefer to hold them until maturity, collect interest, and avoid realizing a loss. And yet, China sold anyway. Not in one dramatic move, but gradually, steadily, and persistently. This wasn't panic selling, it was deliberate. That's what makes this moment so important. China isn't behaving like a typical investor, trying to maximize returns. It's behaving like a strategic actor, trying to reduce exposure. By selling now, China is accepting short-term financial pain to avoid long-term vulnerability. In other words, the loss you see on paper may be smaller than the risk they believe they're escaping. There's also a timing element. As rates rise, the US government must pay more interest to attract buyers. If China waits too long, it risks holding assets that lose strategic value, while alternatives become more attractive. Selling now allows China to redeploy capital into assets it directly controls, including gold, domestic stabilization tools, and non-dollar trade arrangements. This isn't about predicting a market crash tomorrow. It's about recognizing a shift in priorities. Safety is no longer defined purely by yield and liquidity. It's defined by autonomy. And from China's perspective, holding massive amounts of US debt in a world of rising geopolitical tension simply no longer qualifies as safe, even if selling it means taking a loss. The turning point wasn't a balance sheet, it was a precedent. When Western governments froze Russia's foreign reserves after the invasion of Ukraine, the message to the world was unmistakable. Assets held inside the Western financial system were no longer politically neutral. They could be immobilized, restricted, or rendered unusable overnight. For China, this was a warning shot. If it could happen to Russia, it could happen to anyone. And suddenly, holding US debt looked less like savings and more like exposure. At the same time, China's relationship with the United States has become increasingly adversarial. Trade wars, technology restrictions, sanctions, and military tensions have transformed financial interdependence into a strategic risk. US treasuries, once a symbol of global trust, now represent leverage. And China has been quietly reducing how much leverage others hold over it. There are also domestic pressures. China's property sector has struggled, growth has slowed, and capital is needed at home. Selling US debt provides liquidity without relying on foreign systems. It also helps defend the yuan during periods of stress. This isn't desperation, it's preparation. But perhaps the most misunderstood aspect of China's actions is intent. China isn't trying to crash the US dollar or spark a global financial crisis that would damage its own economy. Instead, it's sending a signal to markets, to policymakers, and to allies that it is no longer willing to be deeply embedded in a system it doesn't control. This is strategic distancing, not financial warfare. China is also diversifying, increasing gold reserves, settling trade in local currencies, participating in alternative financial networks. None of these moves replace the dollar overnight, but together they reduce reliance on it. And in global finance, reliance is power. What we're witnessing is not a sudden break, but a recalibration. China is reshaping its position in the global system, step by step, bond by bond. And while the numbers grab attention, the motivation runs far deeper than money. For the United States, China's exit doesn't trigger an immediate crisis. The US still issues debt in its own currency, and demand for treasuries remains strong. But the long-term implications are harder to ignore. With fewer large foreign buyers, the US must rely more heavily on domestic investors and the Federal Reserve. That often means higher interest rates and higher borrowing costs over time. In other words, debt becomes more expensive. Globally, the consequences are even broader. The dollar's dominance has never rested on perfection. It rests on trust, scale, and lack of alternatives. China's actions don't destroy that foundation, but they do chip away at it. As major economies seek diversification, the global system becomes more fragmented. Trade settles in multiple currencies. Financial flows become more complex. Volatility increases. This doesn't mean the dollar collapses. Empires rarely fall all at once. They weaken gradually as confidence shifts and behavior adapts. What's happening now is not a crisis event. It's a structural evolution. One where power is distributed more cautiously and alliances are less financially intertwined. For markets, this means uncertainty becomes the norm. Interest rates stay higher for longer. Safe assets are no longer universally agreed upon. And geopolitical risk becomes a permanent factor in financial decision-making. For everyday people, the effects are indirect but real. Higher borrowing costs, more fragile markets, and a global economy that feels less predictable. These shifts don't show up in a single headline. They show up over years. China selling US debt isn't the end of an era. It's a sign that the era is already changing. Perhaps the most important detail is how quietly all of this is unfolding. There are no emergency summits, no dramatic announcements, no market-shattering moments. That's not accidental. Financial power transitions rarely happen loudly. Noise creates panic, and panic destroys value. Both sides understand that stability depends on discretion. China sells gradually to avoid shocking markets. The US avoids amplifying the story to preserve confidence. And most people never notice because nothing appears broken yet. But history shows that the most significant shifts are often invisible while they're happening. This quiet erosion of trust is far more powerful than a sudden collapse. It allows systems to adjust without forcing confrontation, but it also means that by the time the change is obvious, it's already embedded. China didn't sell because it hates the dollar. It sold because it no longer wants to be dependent on it. And that distinction matters. Dependence creates vulnerability. Independence creates optionality. In a world moving toward financial and geopolitical fragmentation, optionality is everything. What we're watching is not the failure of the global system, but its transformation. A system once built on deep interdependence is being replaced by one built on cautious distance. And China's bond sales are one of the clearest signals of that shift. Empires don't fall when people panic. They change when confidence quietly moves elsewhere. And right now, confidence is being redistributed, not in a rush, not in fear, but with intention. China didn't sell US debt because the system was collapsing. It sold because it was changing. This wasn't a protest, and it wasn't a panic move. It was a quiet decision made long before most people started paying attention. A recognition that financial safety is no longer defined by yield or reputation alone, but by control, flexibility, and independence. By accepting losses today, China reduced a much larger risk tomorrow, the risk of being trapped inside a system that can be turned into a political weapon. And that decision tells us something uncomfortable about the world we're entering. Global finance is no longer just about efficiency, it's about trust. And trust is no longer assumed even between the largest economies on Earth. This doesn't mean the dollar disappears, or that the US loses its financial power overnight. It means that power is being tested, reshaped, and slowly redistributed. The most important shifts don't announce themselves with chaos. They happen quietly, through decisions that seem technical, distant, and easy to ignore. But every bond sold is a signal. Every dependency reduced is a warning. The future of the global system won't collapse all at once. It will evolve, step by step, as countries prepare not for the last crisis, but for the next one. And if you understand those shifts before they become headlines, you don't just see the world differently. You see it earlier. Like and subscribe the Silver Collapse Report for more videos.